Hello, investors. Welcome back to another episode of vishalvealthview. Indian markets are on a mini bull run right now, with indexes like Nifty 50 reaching at an all time high. That's why in today's episode, I'll be ranking famous Nifty 50 companies on the basis of their sales growth. We'll be discussing companies in defense space like Bharat Electronics, companies in consumer space like Trent, Titan, DMart, and Airtel, companies in infra space like Adani Ports, L&T, and companies in financial service space like Bajaj Finance and Bajaj Finserv. So, without wasting much time, let's start this episode. First, let's talk about Bajaj Finserv. Now, this is a parent holding company that manages all the financial businesses for Bajaj Group. This might include lending, insurance, investment, and wealth management. This company has over 100 million users across its various subsidiaries, and it is pretty diversified. So, let's take a look at the fundamentals of this company. If we take a look at the fundamentals of the company right now is over 3 lakh crore in market capitalization. It's trading at a PE of 37, and it has been growing since last 5 years at a compounded rate of 20% in its top line sales growth. Apart from that, the profits have been expanding at almost 25% in last 3 years, and in last 1 year the profit growth has been pretty stagnant at 9%. Now, let's take a look at what's the debt for this company. Now, if you see the debt for this company, it's going to be pretty high because they are in lending business. So that's why they have to take a lot of the debt. But most of that debt is long term borrowings, and it's not going to affect the short term operations of the company, and it's pretty manageable. Now, let's talk about the future growth in top line and bottom line for this business. The revenue is going to grow at around 18 to 20%, and it will be driven by expansion in insurance, lending, and asset management segments. Apart from that, the EPS is going to grow around 20 to 25%, and it will be supported by expansion in margin and cost optimization. Now, how would I rank Bajaj Finserv? In my opinion, on the basis of the revenue growth that's projected, Bajaj Finserv is a solid B. There are other companies that are giving out more growth, projecting more growth, but on the basis of fundamentals, I think Bajaj Finserv is a solid buy. Does that mean you should go out and buy it? No, because I'm not a financial advisor. You should consult a financial advisor before investing your money at any place. The second company on our list is Bajaj Finance. Now, Bajaj Finance is primarily focused on lending across retail, SME. They provide home loans, and one of the special product that they came up with was 0% EMI and 0% loan. I think if you are a working employee, you must have got a call from the sales executive of Bajaj Finance trying to sell you credit cards. So let's take a look at the fundamentals of this company. Now, Bajaj Finance is a subsidiary of Bajaj Finserv, but it has a bigger market capitalization than its parent. Now, this company right now is trading at a PE of 35 and has really high profit margins. Now, if we take a look at the sales and margin of this company, the margin stands at 23%, 24%. This means the company is able to use its profit and re-employ its profit in growing its business. And they are able to give out really high credit loans, really high quality credits that are able to generate high margins for them with really low NPA. Now, if we take a look at the sales growth and the profit growth of the company, it is standing strong for 5 years and 3 years. In 5 years, the top line for the company has grown by 21%, and in 3 years, the top line increased by 30%. And the story is similar for last 1 year as well. Same with profit growth. It increased 26%, 13%, and 15% for 5 years, 3 years, and 1 year, respectively. The EPS increased from almost 8.75 on March 2020 to 26.77 in March 2025. Now, unlike all lending business or like all lending business, this company also has high debt because that's their primary business. They take money on loan to give out money to other people, and that's the difference they are going to take it as profits. Now, let's see what's the future revenue growth that's expected for this company. If we talk about the growth aspects of this company, the top line is going to grow at around 18 to 20% annually. Over last 3 to 4 years, the top line was growing at around 22%, and it will see a slowdown in the coming uh, years. If we talk about the profits for the company, the profits were growing at around 24% CAGR, and it is expected to slow down to around 18 to 22%. Now, if we take a look at the RRG for Bajaj Finance, then in 6 months, the company entered into a leading phase with respect to Nifty 50, and right now it's turning back. Profit booking happened in this company, and it's entering weakening and lagging quadrant. That means if you are a long term investor in this particular company in the coming weeks, you might find good buying opportunities. So, how will I rank Bajaj Finance on the basis of its sales growth? I think Bajaj Finance is a solid C as of now. Its sales and revenue growth is not going to be as high as Bajaj Finserv. That's why it's going to be a C. Next up, we have a multinational conglomerate and it's called Larsen and Toubro. Now, this company is a behemoth. If you have a problem, they'll solve it. This company is offering EPC solution called Engineering, Procurement and Construction Solution across various sectors like infrastructure, defense and financial service. It's really hard for me to explain about all the business segments of this company in words. So let's take a look at the fundamentals of this company. The company has a public market capitalization of almost 5 lakh crore and the company has a PE of 33 right now. That means it's fairly valued. It's not richly valued. If we take a look at the sales and the margins, in last 10 years, the sales have been growing consistently. And as you can see from the nature of the sales, the business is cyclical. The margins of this company are contracting over last few years and they are really thin. That means they're not getting a huge amount of free cash flow available to reinvest in their own business. Apart from that, the debt of the company stands at 1.36. However, from the looks of the balance sheet, the short term borrowings 35,000 crore is fairly less than the reserves that they have. That means the short term borrowings and the debt is manageable for at least 1 or 2 years without any issue. The company is growing around at like 16% in terms of sales, and the profit is expanding at 25% and 23% respectively for 1 year and 3 year. Now, what's the future prospects of Larsen and Toubro? Let's try to understand that. Talking about the future of the company, the revenue is going to grow at around 12 to 15% annually for next 3 to 5 years, and earnings are expected to grow at around 15 to 18%. The key growth driver for this company are additional infrastructure project and the government projects that they're getting across roads, railway, and urban infrastructure. Apart from that, new projects in power transmission and distribution, and the digital transformation that on which L&T is focusing on right now, and they are trying to provide engineering services that include IoT services and automation. Apart from that, they're also going after international markets, specifically in Middle East and Southeast Asia. Now, if we take a look at RRG for L&T in last 6 months over a 20-week window, then we can see the RRG was in the lagging quadrant and it entered the improving quadrant in last few weeks. That means the stock is in its improving quadrant with respect to Nifty and it will be soon overpriced. So if you're planning to build new position from a long term point of view, I would caution you for that because there might be a short term overpricing in this particular stock. And I cannot see a huge amount of sales growth and earnings growth that is being projected. And it's trading at a fair valuation right now. So let's try to rank this particular company on the basis of sales growth. Now, in terms of sales growth, I'll give L&T a solid E. They have significantly less revenue growth expected and profit growth expected with respect to Bajaj Finance and Bajaj Finserv. So they deserve a lower ranking with respect to these companies. Next up, we have Adani Ports and Special Economic Zones. Now, this company is involved in the business of development, maintenance, and operations around port infrastructure. This company has minority stake in a port in Israel called Haifa, and this company stock price actually saw some pressure when the war in Israel broke out. And that's the problem with a company like this. Since they have diversification across so many places across the world, it's really hard to assess the risk associated with the business. Let's take a look at the fundamentals of the company. Now, Adani Group of companies have been on a capex spree in past few years. And if we see that the company has a decent amount of debt around point 0.8, they are a 3 lakh crore company and trading at around 29%. One of the good things about the business model of this company is that it has high sales and operating margin, like operating margins and net margins. This allow the company to generate free cash flow that can be reinvested into its business once again. And another good aspect or a positive aspect of the company does not have a huge amount of depreciation with respect to the sales that they are doing. So, from the fundamentals and the balance sheet, I don't see a major risk from debt point of view. The borrowings are also manageable. The short-term borrowings is only 10,000 crore, and they have healthy amount of cash to handle these borrowings. The main risk that I see with this business is the geopolitical risk. Now, if we take a look at the sales and the profit growth, the sales have been growing around 20% in last 3 years, and for last 1 year, the sales was growing at around 14%. Now, this has an impact of deglobalization of the world, like the sales slow down, and the profit has been growing in last 3 years for about 27%, and in last 1 year for about 21%. Let's take a look at what's the future prospect for this company, what is getting projected. Now, Adani Port is expected to grow its top line by around 10 to 12%, and the profit growth is projected at around 12 to 15% per year. The key growth drivers are going to be increase in cargo volume growth across its 13 domestic ports. Apart from that, they are also increasing their port portfolio, and they have acquired Vizhinjam International Seaport and a stake in it, and they'll be managing that. Apart from that, they are also getting ports in Sri Lanka, Colombo Terminal, and in West Bengal. So these new terminals and these new seaports are going to be new revenue stream for their business. Now, one of the inherent risk I see with the company like Adani Port is the geopolitical risk and also a connection that they have with the current political establishment. I don't want my business to be impacted if the politics is changing or the government in New Delhi is changing. Now, if we see in last 6 months, how does the RRG is changing? The Adani Port was in a lagging quadrant. It entered improving quadrant, and right now it's sitting at a leading quadrant with respect to Nifty 50, and it will soon enter into a weakening quadrant because of the geopolitical tension. So, if you are building fresh positions in this company, just beware about that. Keep that in mind that this company might be a bit overpriced and will be affected by the future geopolitical tensions. I'm going to give Adani Ports a solid F. In my opinion, the company is going to grow at around 10 to 12% in future, and the amount of geopolitical risk that's increasing, I don't feel comfortable ranking this company even higher than that because their sales growth can be affected by the changing geopolitics in the Middle East or in Southeast Asia. Now, next up, we have India's leading food service platform called Zomato, and it's right now called Eternal. They did a rebranding. I don't know why. But this company has been growing rapidly. When the IPO came, the company was completely loss making. Since then, the company turned around. It is profit generating, but still, the company is trading at mind blowing P of almost 400, 500. So, let's take a look at the fundamentals of this company. Talking about fundamentals, this company, Eternal, called Zomato, has a market capitalization of almost 250,000 crore. It's trading at a PE of almost 478. This is a really high PE. Now, one thing you can guess by looking at this PE that this company must be having a high sales growth. They should be in a expansion phase. It's really hard to value a company like this. So if we see the sales growth for this company, it's growing over 60% in last 3 years and in last 1 year, and the same is the case with the profit growth. However, the profit growth looks so high because the profit is just turning around. It started with a really low base of almost zero, and they are now turning the company profitable. If we take a look at the red flags, which is the debt of the company, the debt is relatively low. They have raised capital in the recent times to pay off this debt and make company profitable. However, some red flags that I see is company is highly diluted. The promoters does not have majority stake anymore. But that does happen with companies that are focusing on expansion. Now, one of the interesting thing that you'll see in its margin number is this company has less than 5% as net margin. That means they are not in a state where they can use their capital to expand their business. Till now, they were relying on market, raising capital from the market and raising debt. But in future, the direction of the company is also towards making sure that it's profitable if they want to fuel the next future growth. Now, if we take a look at the revenue growth expected in next 3 to 5 years, they are expecting to grow their revenue by 20 to 25% CAGR, mainly driven by the hyperpure segment and the quick commerce Blinkit acquisition that they did in past 2 or 3 years. Now, the Blinkit acquisition actually is the reason why their sales and their revenue was expanding at a such rapid pace of more than 60%, and it might see a cool down in the future. So that is something you should be expecting. Apart from that, the EBITDA margin is expected to improve from 12% to almost 18 to 20%. That means the company is going to focus on expanding its margin because if they want to be in a state where they want to organically grow, They need free cash flow to fuel their next set of growth. Now, if we take a look at RRG, for the longest time, the company in last year was in the improving quadrant, and in last 1 year, it was in the leading quadrant with respect to Nifty 50, and it's right now still in the leading quadrant. And I think that is in line with the expectation because they are growing their sales higher than most of the companies in Nifty 50. Now, the question comes, how can you value a company like Zomato? Now, one factor I use to value companies that are focusing only on growth is a metric called market cap to sales. Now, these companies usually have higher market cap to sales ratio, and I can compare it with respect to other companies in the same space like Trent or any other newish tech companies. So, this is a good metric that will give you a direction that what, with respect to what sales, what's the valuation of the company right now, and it can serve as a benchmark for you to make a decision. Now, on the basis of the current sales growth, I'll rank Zomato a solid A. They have higher sales growth expected and current with respect to any other Nifty 50 company, and they deserve a higher spot. Next up, we have India's one of the largest telecommunication service provider called Bharti Airtel. They have services across 18 countries across the world. That means they are truly one of the global company, and their stock in the recent time have been touching all-time high. So let's take a look at the fundamentals of the company. If we talk about the fundamentals of this company, this is one of the few companies that has market capitalization of over 10 lakh crore. It's trading at a PE of 43 right now, and it has a significant amount of debt on its balance sheet. Right now, debt to equity ratio stands at almost 2. However, if we take a look at the sales growth and profit growth, there is one interesting thing. The sales has been growing at around 15%. However, profit expanded at 133% in last 1 year. For this, I need to take a look at nitty-gritty details of profit and loss statement. If we see the other income item increased drastically in last 1 year, that means the growth in the EPS might be a combination of expansion in operation and expansion in other income, or them selling some of the subsidiaries that were loss making. So take it with a pinch of a salt because I think retail investors are coming into this stock, and that's why it's reaching at its all-time high because they will be looking at 100% profit growth and the P at just 40. However, if you take a look at market cap to sales, it's touching at an all-time high. That means this stock is not cheap at all for the growth it's offering right now. However, the company has a strong balance sheet and cash flow statement. They have almost 94 crore from profits from operation that they can reinvest into their business. And this entire component gives them a capability of handling any kind of downturns in the future. The company has a strong promoter holding. That means the stakes are in the right hand. Let's take a look at what's the future growth prospect of Bharti Airtel. Now, Bharti Airtel is expecting to grow its revenue at around 12 to 15% over next 3 to 5 years. This growth will mainly be driven by its expansion in India mobile business and their expansion in Africa. Along with that, they're entering TV and broadband space as well. So you can expect new revenue streams opening up from these channels. Let's take a look at RRG now. Now, RRG for Bharti Airtel with respect to Nifty 50 right now is in the weakening quadrant, but it is turning towards the leading quadrant in last 1 week. That means if this particular stock is in your portfolio, keep an eye out for short-term gains and short-term selling if you want to book some profits. Now, on the basis of sales growth, I'll give Airtel a solid D. There are companies in Nifty 50 space that can offer better sales growth in next 2 to 3 years. However, you can see short-term gains in this particular stock because the way the balance sheet and the profit and loss statement has changed in the past few months. Next company on our list is DMart. This company is owned by Radhakishan Damani and it's also called Avenue Supermarts in the public market. Now, the business model of this company is to open a value retailing store in every city across the country. Right now, they have targeted to large extent tier 1 and tier 2 cities. And the model that they follow is they buy big land banks far outside the city area and they convert it into a big value retail store. Folks might have to travel a lot of distance to reach this particular place or these stores, but they get really good deals on the products they are buying. And that's the hook for this company. The margins are going to be low, but the margins are going to be so tough to beat that you cannot get that kind of deal at any other place. So let's take a look at the fundamentals of this company. Now, just like any other FMCG company, Avenue Supermarts trade at a premium valuation. It has a PE of 105 right now, and it has a market capitalization of almost 2,84,000 crore. Now, if we take a look at the sales and the margins of this company, the company has been expanding its sales in last 10 years, 5 years, and 3 years. They only saw some amount of bump in their sales during COVID when there was a lockdown announced. The interesting thing to note here is that they are running their business at a really low margin. That means any other competitor who is coming into the retail business will face challenges to compete with them. Now, this company's business model can be closely compared to another company's business model called Costco in USA. Now, Buffet and Munger were early investor in that company, and they also were running their business at a really low margin, making it hard for any other competitor to come into the space. Now, the only risk I see in the business model of this company is as quick commerce develop and as users' behavior change, they might start preferring getting deliveries rather than going to the store physically. This might be one of the risks that can come because of user behavior, but Indian market and Indian consumer are really price sensitive. And if we take a look at the sales growth and profit growth of this company, the sales have been growing at a CAGR of 24% in last 3 years. In last 12 months, the sales compounded by almost 7%. The story has been same for profit growth as well. In last 3 years, profit grew by 22% CAGR. In last 12 months, profit expanded by 8% CAGR. The company is not doing any kind of dilution in last 1 year or 1.5 year. So shareholding wise, I don't see any red flag. And promoters are majority stakeholder. That means they want to grow their business. One more interesting thing is the cash flow statement. The company maintains a healthy amount of free cash flow that they can use for reinvesting in their business to expand their business. This is the money that can be used to buy more land across the cities and build up more stores. Let's take a look at what's the future growth prospects of the company. Now, if we talk about next 3 to 5 years, they are planning to expand their revenue by 18 to 20% CAGR. This is a healthy expansion, and this expansion is going to be driven by first of all store expansion. They are going to increase their store 365 from 365 to 1000, and they're also going to push their private labels. Now, private labels are the brands or products that are owned by Avenue Supermarts or DMart itself, and they will have relatively higher margins than any other product that they're selling from any other brands. For example, if DMart is selling Maggie, they will have less margin on that Maggie that compared to if if they're able to produce their own Maggie or their own noodles, and if customers are buying it. Apart from that, they're also thinking about opening up e-commerce and quick commerce store in 12 cities, and they are planning to expand it to 30 cities in the coming months, in the coming years. And the reason is they will face competition from companies like Zepto, Blinkit, and they will be one of the challenge in the growth of a company like DMart, especially in tier 1 cities where there's a lot of traffic and consumers don't want to travel anymore to a place like DMart. Apart from that, they are also thinking about expanding their categories, introducing staples and daily needs, planning to improve their operational efficiency, and what are the benefits or opportunities that exist in front of them from rapid urbanization and mentality of folks shift to cities from tier 3 or tier 4 cities. So these are the themes on which they'll be growing for next 3 to 5 years with a CAGR of 18 to 20%. So on the basis of the current sales growth, I'll rate Demarta solid B. I think their sales growth is going to be mostly organic in nature, and it's not going to be driven by any kind of debt. That's the best kind of sales that you can expect in the market because it's hard to take that away. So I'll rate this as B. Next we have is Titan. So let's take a look. Now, Titan is one of the largest lifestyle companies in India. This company is backed by Tata Group and Tamil Nadu Industrial Development Corporation. It was founded in 1984, and its primary business is jewelry business, even though they are moving into entire lifestyle space. Rakesh Jhunjhunwala, one of the famous investors in India, is a long-term holder in this company, and he had vouched for the business model of the company. So let's take a look at the fundamentals of this company now. Now, just like any other FMCG company, Titan also trades at a premium valuation of 100. It has a market capitalization of 3,29,000 crore, and it has a relatively higher amount of debt, almost 1.80 debt to equity ratio. If you take a look at the sales and the margin, the sales have been growing ever since the company was founded, and they are able to maintain their margins across multiple cycles, multiple years. This is across recession, wars, and any other things that are happening across the world. So the company has a strong business model, they have a good consumer base. Now, if we take a look at the sales growth, they are able to give us double digit sales growth in last 3 years and in last 1 year. The same is the case with profit in last 3 years. However, profit dropped in last 1 year. So let's take a look at what happened in last 1 year that led to decline in profit. As you can clearly see, the expenses increased drastically as the profit and the revenue increased. That might be one of the reason why EPS was dropped. One of the good things about this company is this company, even though after being like one of the biggest company and facing a lot of cycles, the company did not dilute too much. The company still has major promoter holdings, more than 51%. That means the company's promoter will have higher amount of stake in seeing this company succeed, which always reassures the investor. Now let's take a look at the future growth prospects of Titan. Now it's projected that over next 5 years, the company is going to grow its sales by a CAGR of 18 to 20%, and this will contribute to almost 75% of their total growth from jewelry business. The other business like Titan Eye Plus, Fast Track, and Raga, they'll see a healthy but not explosive growth of 12 to 15%. So how will I rank this company? So based on the current sales growth, I would rank Titan a solid B, just equivalent to DMart. I think both DMart and Titan, even though they are operating in completely different space, one is in FMCG, one is in jewelry. I think both of the company has relatively similar business model. They operate on low margin. They use the free cash flow to open new stores and expand their business organically. Next up, we have another Tata Group company operating in lifestyle and apparel space. It's called Trent. You must have heard of this company by its brand called Westside and Zudio. If you go to any mall in India these days, they'll have one of the most prominent stores in that mall. The company mainly operates on a concept called fast fashion. They target younger generation for the clothes that they offer. So let's take a look at the fundamentals of the company. Now, this company has been on my radar for almost 3 to 4 years now, but I was never able to invest in this company because of the high PE this company trades at. Right now, it's trading at a PE of 153. It has a total market capitalization of over 2 lakh crore. But PE is the main problem. This company was trading almost at a valuation of 233 last year, and I was not comfortable building new positions in this. In the recent time, the valuation have cooled down a bit. And if we take a look at the sales, we saw some amount of sales decline in the last quarter, and that's the reason why prices might have cooled down. The company maintains a healthy margin of about 8 to 12, 10%. That means they're able to get good free cash flow that they can reinvest in their business. Talking about debt, the company is paying down its debt. They are reducing their debt in last 2 or 3 years. They were in an expansion phase, and right now they are cutting down their debt. If we talk about the sales and the profit growth, it's amazing. The sales was compounding at almost 56% in last 3 years because they were opening new stores. And last 1 year, the sales expanded by almost 38%. If you see profit compounding in last 5 year, profit compounded at 72%, and in last 3 years, it compounded by 37%. One of the key factor is the other income factor in this last 2 year earnings that happened. So if you see, one of the major component in 2024 was other income. This might be because of uh, s- Trend selling some of their subsidiaries to other company. Talking about shareholding pattern, the company does not have any majority stakeholder, but the company is backed by a really strong promoter group called Tata Sons Private Limited. That means it will have a strong backing moving forward. The company maintains a healthy free cash flow from operations that they can use to reinvest in their business to open more store and grow their organic business segments. Let's take a look at the future growth prospects of this company now. In future, trend is expected to grow at about 12 to 15% CAGR despite its high historical revenue growth. And this historical revenue growth was primarily driven by post pandemic rebound as folks went out, they had some amount of savings, and they shopped in stores like Zudio. Apart from that, they were in an expansion phase. They were aggressively rolling out Zudio across the country, and this was one of the main reason why they saw an explosive growth in past few years. That means for Trent in the coming years, the goal is going to be improving their margins and like clearing down their debt and provide more value to the shareholders. So let's try to rank this particular company based on the sales growth. So I would rank Trent a solid D. The sales growth is not going to be similar to the sales growth we have seen in the past, but still it's a solid business and the sales will be in line with Nifty 50's growth. Now, last but not least, we have Bharat Electronics. Now, Bharat Electronics is observing a massive bull run right now as I speak. The company stock price is touching all-time high every new month. And the company mainly operates in defense sector. They produce electrical components that will be used by defense sector with a minimal amount of civilian use case. Since the war in West Asia broke out and the conflict between India Pakistan escalated, the company is observing a massive bull run. So let's take a look at the fundamentals of this company and try to understand what's the future sales growth looks like. Now, this company has a balance sheet, what Trump would call a big, beautiful balance sheet. The company is trading at a PE of almost 60. It has a market capitalization of 3 lakh crore and it does not have any debt on its balance sheet. It is able to employ all of its cash in growing its business. Now, if we take a look at the sales and the margins of the company, both sales and margins are expanding in past few years. However, you need to wonder what are they doing with the free cash flow if they're not even using that money to pay down their debt or giving out dividends to the shareholders. And the argument over there is they might be using that money for two purposes. One is for R&D because defense is a space that is really niche. You need to have a cutting edge over your adversary. Second, they can be spending that money on setting up new industries, plants that can produce the relevant amount of products and relevant products that the defense sector of our country needs. So all in all, I think this company has a strong balance sheet. The company is growing at almost 17%. It is able to expand its sale by 16% in last 3 years, and they are able to expand their profit growth by over 30%. The company's stock price was growing in line with their profit growth and their sales growth. So let's take a look at what's the future of this company. What is the sales growth that they can expect in future? Now, talking about the future growth prospect, I think the main growth is going to come from the government spending in the Indian defense sector. And they are expecting a minimum revenue growth of almost 15% and expanding that revenue growth by almost 20% by 2030. Now, that is an interesting thing. I think this is a sector that might see a rapid expansion as the needs changes and as the situation on the ground changes. The government might have to spend relatively more money if we are in a conflict kind of situation. So that uncertainty will always remain with this company. However, this company will act as a hedge whenever there is a war or conflict kind of situation, and the entire stock market would be in a downturn. So, what's my take on this company now? Now, on the basis of the sales growth, I'll rank this company solid B. It will have a sales growth between 15 to 20% in 3 to 5 years. However, things can change on the ground if things geopolitically changes and there is tensions in West Asia or in Southeast Asia. I hope that's not the case, but that's how things stand currently. So this is the final ranking of all the companies on the basis of sales growth. On top, we have Zomato. On second level, we have Bajaj Finserv, DMart, Titan, and Bharat Electronics. On third level, we have Bajaj Finance. On fourth level, we have Airtel Trend. Then we have L&T. And at last, we have Adani Ports and Logistics. And that's it what I have for you for today's episode. I hope you enjoyed this video. Do hit the like button and subscribe to Vishal Wealth View. Bye bye. Stay safe.